Welcome to our video on investing in cryptocurrencies in the dividend incomes plan. Investors have a plethora of possibilities in the digital age of today to increase their money. Investing in cryptocurrencies and dividend earnings are two popular options. Before choosing which of these two tactics is best for you, it is important to grasp their distinctions since each has certain benefits and hazards of its own. We will go into the topics of dividend incomes and cryptocurrency investing in this video, going over their foundational ideas, possible rewards, and possible drawbacks. For those who are new to investing or those with experience, this video is meant for you. Before starting, don't forget to like and subscribe to our channel for more future updates, and also don't forget follow my TikTok page Capital Gains 1. Number 1. Definition and overview. A dividend income strategy is a way of investing in which shareholders of firms they have invested in pay out dividends to investors on a regular basis. A percentage of the company's earnings are given to its shareholders as dividends. Typically, investors seeking a consistent and dependable stream of income choose this approach. Investing in cryptocurrencies, on the other hand, entails purchasing and holding digital assets, with the goal of turning a profit down the road. Cryptocurrencies function via a peer-to-peer, decentralized network, because market demand and investor mood are what ultimately determine their worth. Number 2. Historical performance. The dividend income plan has been a tried and true approach to building wealth, based on a Bank of America Merrill Lynch analysis. During the last 30 years, dividends have contributed 42% to the S&P 500's overall return. Additionally, businesses that have a proven track record of paying dividends have shown to be more resilient during market downturns. However, it is difficult to evaluate cryptocurrencies' long-term success due to their relatively recent history. The first and biggest cryptocurrency, Bitcoin, has grown significantly, but it has also been quite volatile, with regular price fluctuations. Therefore, it is still unknown how well cryptocurrency investments have performed historically. Number 3. Risk management. Companies that pay dividends are often well established, financially secure, and have a profitable track record. The dividend income approach is a comparatively lower risk alternative since they are less likely to go bankrupt. Furthermore, dividends provide investors with a steady income stream by acting as a buffer during market downturns. However, since cryptocurrencies are so volatile, investing in them carries a considerable risk. Cryptocurrency values are subject to large swings in a short amount of time, and profits are not guaranteed. Furthermore, they are very speculative since they are not supported by any tangible assets. Because of this, investors in cryptocurrencies must be ready to deal with significant risk and volatility. Number 4. Income generation. The main goal of a dividend income plan is to provide investors with consistent returns. Usually distributed quarterly or yearly, dividends may provide a reliable passive income stream. Because of this, it is a desirable choice for investors or retirees looking for a steady source of income. However, investments in cryptocurrencies don't bring in any money. The market value of cryptocurrencies determines all of their returns, and investors may only benefit from sales during price rises. For investors looking for a consistent source of income, this makes it a less desirable alternative. Number 5. Liquidity. Stocks that generate dividends are readily purchased and traded in the market because they are generally liquid. When it comes to transaction costs and delays, investors may easily cash out their money. Cryptocurrencies, however, could not be as liquid as equities that provide dividends. Although the cryptocurrency market is always open, it is still tiny in comparison to other conventional financial markets. Large transactions might thus result in significant price fluctuations, and investors might need to wait for a buyer who is ready to acquire their assets. Number 6. Regulation. A dividend income plan is a regulated investing approach, and dividend-paying corporations must adhere to certain transparency and reporting guidelines. This offers a certain level of safety and transparency to investors. However, as cryptocurrencies are decentralized digital assets, they are exempt from many laws. Concerns over possible frauds, market manipulation, and the security of investors' money have arisen as a result of this monitoring gap. Number 7. Investment horizon. A long-term investing perspective is better suited for investors using the dividend income approach, because dividends might be received quarterly or yearly. To observe noticeable results, patience is required. But over time, the force of compounding may significantly increase an investor's wealth. However, investing in cryptocurrencies has the potential to provide large short-term profits. making it appealing to investors with shorter time horizons for investments. But, because of the short-term volatility of the market, there is also an increased risk associated with this. Number 8. Diversification. Investing in equities from diverse firms across many sectors via dividend income approach facilitates diversification. This lessens the effect of market downturns and helps to spread out the risk. Additionally, dividend-paying businesses are often dependable and well-established, giving investors a certain amount of assurance. However, since Bitcoin dominates the market, investing in cryptocurrencies offers few possibilities for diversification. Because cryptocurrencies are so volatile, diversification is a difficult way to reduce risk. Number 9. Entry barrier. Due to the fact that it just needs, investing in the dividend income method is very simple. Establishing a brokerage account and buying equities that pay dividends. It is also accessible to a broad spectrum of investors, since they may choose firms from a number of industries. However, investing in cryptocurrencies requires technical know-how and proficiency. Because wallet services and specialized exchange platforms are used by the market to operate. For first-time investors, the learning curve in cryptocurrency investment may be rather high, making it a more difficult alternative to invest in. Number 10. Tax implications. Taxes apply to dividends from dividend income strategies since they are taxable income. Even though the tax rate on dividends is usually lower than the tax rate on regular income, investors must nevertheless take this into account. However, as many nations have different tax rules, the tax ramifications for cryptocurrency investments are still being explored. Nevertheless, capital gains tax is often applied to cryptocurrency investments, which means that when investors sell their holdings, they will have to pay taxes on their earnings. Conclusion. Both strategies of dividend income and crypto investment have their own unique advantages and disadvantages. The dividend income method gives investors a consistent income stream by depending on the expansion and stability of well-established businesses. Conversely, investing in cryptocurrency has a significant risk and volatility but also has the potential for large gains. These strategies vary mostly in what their underlying assets are. While cryptocurrency investments are based on digital assets that are not backed by any real or tangible assets, dividend income is dependent on conventional assets like equities. The prospective risks and profits of any approach might be significantly impacted by this basic difference. This is it for today's video. What do you think of our video? Let us know in the comment section below. For more updates in the future, don't forget to like and subscribe to our channel. Thanks for watching.